introduction about our company. Wealth Tree Group is a company which has started in 2016. Previously, we were doing not as a company, but as an individual basis. We are doing all these services, what we are doing now, but on different names. Then we thought, let us create some brand where we can create everything at one place. So with the vision of giving everything at one place, we started this. This is a wealth tree. Tree means you will get everything there. So we have 6 verticals: financial planning, we are into insurance, we are into mutual funds, and we are into research of stock markets from last 25 years. And we are into training, especially our main focus is training. Why? Because so our tagline of our company is educate, empower, and enrich. If we educate, people get empowered and they can be enriched. This is what is our vision of the company. That's why our main focus is giving education to the people. In the part of that particular vision, today we are conducting this webinar. Okay. And we wanted to be one of the India's financial education and investment solution provider with the customer satisfaction, top rank in the customer satisfaction. So who are all our customers? They should be happy. That is our motto. Our client financials, see, we want to become a partner with you in helping you to make right financial plans. And in fact, in other ways, like going for the right investments. And then if you're doing something called investing in different aspects, what are the right investments? So we want to become a partner with you to suggest you the right things and empower you with the right knowledge so that you can take the decisions appropriately, which can help you in building your future in a right way. This is all about the company. So generally, what is that in your mind? What are the questions generally you will have in your? That's what I asked actually before starting the webinar. How can I build corpus my child future? If you are married, how much should I save for my retirement? Obviously, everybody retires at one day, isn't it? So then what is the amount that life insurance I needed? And why life insurance needed, we will discuss about it. What are the type of investments should I own? What kind of investments that I can choose? Can I afford a new house, or how I can save taxes? Everything is everything will be covered in the financial planning. Okay. So normally people always think it is not possible to fulfill all their goals and dreams without having high salary or belonging to a rich family, but it is not the truth. That's what I said. People who have plenty of money, they only need financial planning. It's a myth. No, whatever money you are making, you need a plan. And if you are making less money, you need a bigger plan, because only planning can give you more efficiency, and then you can actually save whatever you have and create some wealth creation. So that is what is important. So there is nothing that you should think that, yeah, I should have a lot of money to do the financial planning. No, with the help of financial planning, you can achieve all your goals and dreams. And planning is bringing future to the present. There is something called begin with end in mind. Okay, after 5 years, where I am supposed to be? After 10 years, where I am supposed to be? After 20 years, where I am supposed to be? So you are going to calculate backwards. You are right now sitting in the future and coming to the present. And right now, if you do what, you will go to that future. This is what is the planning that is required for the future. The golden rule is Warren Buffett, the master of investments. He says that do not save what is left after spending, but spend what is left after saving. So can you go back and see a lot of people want to save? Why we are not saving? Why saving is not actually become an important, essential thing for us? A lot of people, even me, for example, I earn crores of rupees, but the thing is that I never save. And today I'm speaking to you and sharing. But the point is that till I get into this subject of financial planning, I don't know the importance of saving. So what Warren Buffett says is, do not save what is left after spending. Generally, we have a notion that we will save money after clearing all the expenditure. Then some money, if it is saved, then I am going to save. This is what is the context generally in our mind. But it will never happen, because something the other will come up and then you will keep on spending money. So saving should be becoming an expense for you. then only you can save. First, you need to change the attitude of saving. That means, first of all, you need to see, you are paying rent, you are paying electricity, you are paying your bills every month. They are must, isn't it? First thing what you are going to do is, after getting salary or after getting your income, immediately top priority is that you are going to pay your important bills and then whatever commitments you have. Once saving comes into that priority, that means suppose you are earning a lakh of rupees, you are paying a rent of some 20,000 and electricity bill of 2,000 or some other commitments you have, you are doing that, and saving should be part of it. That means saving should become an expense. That means, yeah, I am going to save this 10,000, and after that I'm treating it as an expenditure. After that, if I left with some money, then only I'm going to spend. So that saving should come an important expenditure of your income. That means your plan. So then only you can save money. So you can relate with your life so far. So you wanted to save a lot of money. Why you are not able to save? Ask the question yourself. You will get this point that where you will actually come to the same thing, that because of expenditure I could not save the money, and that is the reason I could not save. That is the end point. So now the first point what I wanted to make is, saving should become your expense. That means it's important expense, and without that you cannot have your budget. So saving also should become like a rent or any bill that you are regularly paying every month. That should go to that, and after that, if something is left, that only you are going to spend. So human psychology is generally what happens, whatever we have, we will adjust in that. So saving, once saving is over and we have less money, still we will adjust to that. But if you don't have that plan, what will happen? You will obviously spend that money also, because you don't have the priority for the saving. Okay, so I think everybody got it. So then when it comes to the financial planning, the process of managing your money in the way that can help achieve all your financial goals with ease and protect you from the uncertainty and contingencies. That means life is very uncertain. You never know what's going to happen, isn't it? Anybody knows that what is going to happen? You will become a god. You are not a human being. So obviously life is very uncertain. You know that. So, but if you don't have a plan in this uncertain life, you will end up with some breakdowns in your life in future. If you have the proper plan, there is a chance that you can actually address this uncertainties in a right way. Okay, planning for uncertainty, contingency planning, and goal-based investing. So you will have a lot of goals. So first of all, there is an uncertainty. You have to address that, and then contingency plans. Then something will come up. Suppose you have children, grown-up children. They have to get married. That has to be done, and something will come up in between. You have to do that also. So a lot of things will come up in life. So you have to have the contingency plan, and then goal-based investing. You know what you want. You have dreams. You want to buy a house, and you want to create some retirement corpus, and you want to buy a car, or you want to go for a holiday. There are a lot of priorities of life. There are a lot of goals. So for that goals, what that I have to invest now to achieve that goal. So this planning is very, very important in the financial planning. So what are the stages of life? When we see a lot of the stages of life, first stage is income stage. That means you are going to Sridhar Garu, can you go on mute? Yeah. Okay. So first stage is income stage. That means you are trying to get the income first. That means you want to become independent by earning your own income. Second is the dependent stage. That means you are going to have dependents on you. That means you are going to get married, and then you have to check children, and then your career is at the peak stage where you started earning good money, and that is what is called growth stage, where you will multiply your income, and then you are going to create some good corpus for your life. And then last stage is retirement stage. Okay, these are the general stages. That means you will become an independent, and then there will be some dependence on you. and then there is a growth that you look at because you want to build your life, and then there is a retirement stage. Something will come up after this, no doubt about it. Only thing is, it is inevitable, isn't it? Retirement is inevitable. So you will get old age, and then you have to plan properly, isn't it? You should not depend on somebody else. And like nowadays in this kind of environment, you cannot even depend upon your children. So obviously, this is the most important stages. These are the most important stages of our life, and we need to really address all these stages. Okay. So what are the benefits of the financial planning? So achieving financial goals, improved financial understanding, okay, financial security, then preparation for emergencies, improved standard of living, and financial independence. All are correlated actually. So overall, what it is all about it is the getting understanding of how to do it, how to manage your money in a proper way so that you can create the future and you can actually achieve your goals in a proper way. That is what is the understanding benefit of the financial planning. If you don't have this, what will happen? You don't know where you will go. So obviously, I'm here at Banjara Hills in my office. If I don't know that I have to go to Dilshuk Nagar, I cannot go. At least I have a goal that I have to go to Dilshuk Nagar. Then there is a chance, by ways or means, I can go to that place. Okay, maybe one day late, I may go to that place because I have a specific goal to go to some area, isn't it? But if I don't have, what will happen? I'll be roaming around Banjara Hills, thinking that I will go to some place. So this is what is the importance of having a goal. So goal should be like something like you need to have. Otherwise, if you don't declare your goals, you will never know where you will end up in your life. So first of all, declaring the goals is very, very important. Okay. And what is the pyramid of financial planning? And I'm going to explain one by one very clearly. First thing is addressing the uncertainty. You are not the God, and we never know what's going to happen tomorrow. That is the baseline, and nobody can change it. The first part of financial planning comes is the protection. Protection for whom? Protection for everything. We are going to explain it in detail. Then next one is saving. First is protection. Next one is saving. What is that saving? Saving is always like, yeah, you have earned some money and you want to save it for your future. So how to save that money? That is the second part of financial planning. And third one is investment. Okay, after saving, you need to invest in some area where you will get maximum returns out of that particular investment, and how to choose those investment options is the part of the financial planning. Okay, so let's go by one now. And financial planning covers the aspects of money management. What are all money management aspects? First of all, so let us talk about what are all the aspects of money management. First is that uncertainty. That is what comes insurance into the picture. Okay, there is only one product in the world where your uncertainty is covered. Okay, you buy a property, fine, but when you sell that property, you will get that money, isn't it? But for buying property, you need a lot of money. Insurance is only one product. You pay some premium, but you are covered for your life, and you are covered for your health. You are covered for your car. You are covered for your property. You are covered everything on the earth. So that is only the product which actually addresses our uncertainties in life. People don't understand this. They think that insurance is something else. No, insurance is only the product in the world where you will not be paying high, but you are be paying only premium, very small, but you are covered for entire risk of your life. And that is what you need to understand. And it is very, very important aspect of financial planning. And so many people don't do it properly, and they end up wasting their money. So today we are going to give you a lot of focus on that. Then emergency fund, what it is. So always there will be some emergencies. Okay, something will come up like COVID. Who expected that COVID will come in 2020? Nobody, isn't it? World is so uncertain, and we never have any control on it. So you always should keep some emergency fund with you to cater to the emergencies which can happen. So nobody actually, what will happen when some emergency comes up, somebody hospitalized or something happens, and people broke their financial plan because everything they will get from the people, and then they will be into debts, and but for servicing that debts, their life goes. So this is the most important thing is in the planning is that you need to create some emergency fund which actually cater to your emergencies in your life. Then another one is goal planning. So what are all your goals and how to plan them? And retirement planning, investment planning, and tax planning. So we are going to cover one by one. So in life, there are two possibilities. Either you can live too long, maybe 100 years, or either we can die early. Only two things are possible, isn't it? So obviously, both the things are having some kind of repercussions. One is that living too long. If we are living too long, what will happen? You have a lot of responsibilities to fulfill, isn't it? You have child, and then you have child education, you have child marriage, you have to have vacations, and you have to have the retirement. So all these need to be addressed. And if there is a possibility of early death, yeah, you need to address that also. Whether you are there or not, your dependents should not broke their financial strength. That is what is very, very important when it comes to the early death. So life has got two things, and two things need to be addressed properly, and that is the most important aspect of the financial plan. So when I talk about the protection, insurance is the product which we have to understand what is this product first of all, and then protection is the foundation step of securing future. We are not gods. We don't know what is going to happen tomorrow. And for that, what we need to do, we need to secure. Suppose I am actually earning a lakh of rupees per month, and with that income, my family is living. And tomorrow something happens to me, who is going to feed my family? Who is going to take care of my family? Since I am responsible, this is my prime first responsibility to see that whether I am there or not, my family get the same comfort of living. And for that, I need to insure my life to an extent where even though I'm not there, the same kind of money that goes to the family, whether I'm there or not. So this is what is the understanding of insurance. Not only life, it's a family, then car, then health, then travel, then money, then home, then business. Everything is got insured. Okay, so everything is like uncertain, and whenever there is an uncertainty, you need to cover it. Evaluating risk and determining proper insurance coverage to mitigate those risks is very, very important. So first of all, people don't understand the product of insurance. A lot of people ending up buying some policies where insurance is not covered, and even they don't get proper return. So that is what it is. So the problem is that educating yourself. First priority, yeah, you can even invest in the investment policies, not a problem. But when first you have to cover your life. Suppose, for example, I will give you a classic example of a person who is highly qualified, but his understanding in financial planning is very poor. He's my friend. So he's a doctor. Basically, he runs 3 to 4 dental clinics. You know what is his income? His income is almost around 5 to 6 lakhs per month. Okay, and when I start with him, it is portfolio. He has got his life covered for only 30 to 35 lakhs. So he has got all investment policies. He's paying heavy premium. But the point is, when I look at his life coverage, the sum assured of life coverage, it is only 30 to 35 lakhs. That means he's covered for 6 months of his income. That means his family, what he is going to get is 6 months of income if something happens to him. Whether it is sufficient for that family to live entire life with that income, as he's giving a comfort of 5 to 6 lakhs every month. So this is what is the problem in understanding the insurance. People don't understand, first of all, the thing is what is important. Important is how to calculate your life insurance. The first point, how to calculate your life insurance is whatever comfort you wanted to give to your family. Right now, whatever you are giving to the family, you should be able to give the same thing even though you are not there. That means your life should be covered to that extent. That is what is called term policy. Okay, where you need to get a term policy, and taking term policy at the early age has got a lot of benefit, because it grows up, that premium grows up when you are becoming aged. That means 25 years people, if they want 1 crore term policy, they will get it for some 15,000 to 16,000, below 20,000, I can say. The same policy, if you are opting for it 45 years, you wake up and then you want your life insurance, and you started planning at that time, 45 years, same thing will cost you exactly double or triple than whatever you are paying at 25 years. So taking life complete cover is very, because you are going to have dependents. Maybe you are not married right now, but you are going to have marriage and you are going to have children. So you need to understand this and block your premium at the lowest level, where you will get maximum advantage of the life insurance. And then when it comes to health insurance, after COVID, what is happening? After COVID, what is happening? When you go to the hospital, even there are some cases where they have put a bill of 30-35 lakhs. They kept them in ICU, and then they were there for 15, 20, 30 days, and then so you never know. So now you have to check your health insurance policy, where there are a lot of plans available in the market. You need to evaluate the plan which is suitable for you. And already, if you have the plan, you need to top up that plan. That means you might be having some 5 lakhs, which is not sufficient in this condition of the market. So if you go to the hospital, you never know. There is an uncertainty, isn't it? So you need to understand how much my family require as a health insurance. Okay, total maybe 20-25 lakhs. If it is not there, you can get very, very less premium top-up plans. You have to top up your existing policy. And there are a lot of employees, okay, and they're fully covered by their company. The problem is that employees is, when a company is giving you the health insurance policy, they are going to cover as a team. That means you are not going to have any individual health insurance. So obviously, when you leave that company, you end up with nothing. That means you have to take again. So and one more problem in health insurance, people need to understand this is, first of all, health insurance will not cover everything at the first year itself. Suppose you buy a health insurance policy, from tomorrow everything is not covered. Some diseases covered after 1 year, some diseases after cover 2 years, and all the pre-existing diseases will cover after 4 years. That means you need to have experience of 4 years, then only all your pre-existing diseases will be covered. So many people don't tell you. So many sales people don't tell you this. And unnecessarily, you will be thinking that, yeah, accidents and other common fevers and all covered, not a problem. That too, you need to be there 24 hours in the hospital. Then only health insurance will get covered. So these are small things people don't know. That's why I'm trying to explain you today. So what happens in health insurance is, suppose you have gone to a doctor, unless until you join in hospital for 24 hours hospitalization, then only health insurance will apply. So you need to educate yourself what is health insurance and how it works. So employees always suggest, if company is providing a health insurance, but you also should have your personal policy, where after 4 years everything is covered, and then even though you leave that company, you are protected with your policy. This is the most important and critical. A lot of people face the problem, because when they left the company, they end up with not having health insurance, and again they started right now after 4 years only they will get all the benefits. So this is the more critical, and you need to understand. And there are some products in insurance, like where you can actually secure your business, and there are some professional indemnity, the general insurance, a lot of things are there, where everything, even a home, when you construct a home, and you will take up some loans to construct that home, but so many people ignorant to take the insurance for the loan. So then what will happen? Example is my brother. He died with a brain stroke at the age of 43. Okay, I'm telling you the live example which has happened to me. He took a house loan, and I told him very clearly, take up insurance also for the loan. And he said that he's 6 feet taller, and then he's very strong, and he's perfectly health-wise good and all. He's used written. The point is that his overconfidence. What happened? He died. in 2015. And the problem is that after that, his wife is ending up paying all the premiums of that loan. So otherwise, because he's earning and he's able to pay, but his wife is not earning. Now, from where she will pay? So this is what you need to understand, the importance of ensuring everything which is important for you in your life. Okay. And when it comes to insurance, what's happening in the market? Let us see about it. Poor financial literacy. So that is the most important thing which I want you to understand. Large section of people don't do basic research before buying, don't understand difference between insurance and investment. That is the problem. Investment should give you the returns. Insurance should give you the risk coverage. That's it. Don't club up both the things. Okay. And even you club, see what is the return that it is giving, and what is the cover that you are getting. Both should be analyzed properly, and then you should think about getting into a plan. Yeah, there are some child plans, there are from retirement plans also, insurance with linked with the like investments like ULIPs, which is like a mutual fund. Okay, but point is, first you have to adequately cover your life, then you can, if you have extra money, you can even opt for those plans, but not initially just taking investment policy. Term plan is not at all advisable. Then lack of understanding of risk, not having proper plan of life priorities and risks involved. That means basically, like you are worth of say 100 crores. If you insure for 1 crore, what is the use? Like the doctor, he is worth of minimum of 15 to 20 crores. Okay, because he's earning 5 lakhs per month. You can understand he lives for another 40-50 years, and what kind of income that he is going to accumulate. So he's worth of maybe 25-30 crores also, more than that, in fact. But what is the insurance coverage he has got? Only 30-35 lakhs. So this is the problem of understanding risk. What is the risk? If something happens to me, and then how my family is going to. So everybody should become responsible first. Why responsibility? Because you have people who are depending on you. You cannot, like my brother, you cannot be arrogant to think enough that nothing will happen to me, and I have properties, I have my I'm having a lot of other things. Fine, maybe, but the insurance only one product which gives you, whether you invest or not, you just pay the premium, you will get the entire risk coverage. So that is what. And most of the people, how they are buying insurance is because of the relationship with the people. Suppose I know some LIC agent, or I know some Prasad from Wealth Tree, and okay, and whatever Prasad say, I will take. No, even I say you need to study your life. You need to understand what are the priorities your life, what is risk of your life, what is your annual income, and how much comfort that you wanted to give it to your family, and how you are going to really calculate and take a proper plan. This is you need to understand. Most of the like breach of trust, believing people who are selling wrong products for the sake of their personal benefits. Okay. Suppose you don't have a term plan. Suppose Umakant, you came and met me, and then I know that your annual income is so much, and you don't have term plan. Okay, but I may suggest you some product like, okay, what like some product which will give me more commission, but it will not give you life cover. That means you will be paying some 50,000 or 1 lakh rupees. So in investment policies, generally what will happen, you know, like if you pay 1 lakh premium per year, you are going to get only 10 times of coverage. That means you are going to get 1 crore coverage. The same 1 crore coverage, if you take the term policy, you will be ending up paying almost like maybe 25-30,000. That means you are going to cover for this thing 10 times of sorry, it's not even 1 crore. If it is 1 lakh, it is your insurance is only for 10 lakh. That means 10 times of your premium in investment products. So you need to see whether your insurance coverage is adequate or not. First thing is that if it doesn't have, you don't have the proper insurance coverage, first take that insurance. Then you think about investments. This is the Bottom line, you need to understand. And insurance cannot be taken through a relationship, or you cannot think like that. Somebody is asking you, forcing you to take some policy. No, you need to study what you are taking and what are the inherent things in that, what are the benefits in that, and how we can, even in ULIP plans, there are a lot of ULIP plans available in the market. What is that ULIP plan? There are only three kinds of insurances available. One is a term plan, which is must for everyone. Okay, bottom line. Second is there are plans which are linked with, that was called endowment plans, where they will put money in the debt funds. Debt funds is low risk funds. They end up giving around 4 to 5, 6% return. Okay, and out of that some charges, if you remove it, you will end up getting around 5%, 6% maximum return. Okay, but you are going to get cover only 10 times of your premium paid. That means you are paying 50,000, you are going to get life cover only for 5 lakhs, which is not at all sufficient. So first you need to take term plan. Then endowment plan, people who don't want to take risk at all, but they want extra, like even 5-6% is good return for them, and they also get some insurance extra. They can opt for endowment plan. And another one is called ULIP. ULIP is nothing but it's like a mutual fund. Like mutual fund companies, insurance companies also like have their own funds. That means they have funds in different sector, large cap, mid cap, small cap, like mutual fund. And what they are going to do is this insurance premium, whatever you are paying, they are going to invest in those funds. And according to the market condition, the funds are going to grow. It is little better than the endowment plan. That is what ULIP plan. Previously, there used to be much higher charges, where people used to fearful about the ULIP plans, and there was a lot of propaganda happened. But in 2014, IRDA, regulator of insurance, they have changed a lot of rules, and they have decreased the like charges which are charged by the insurance companies. Now almost investing in ULIP, investing in mutual funds is almost equal, and then you can also get insurance coverage. So people who are ready to invest in markets and they want insurance also, they can actually opt for this kind of plans. In that also you need to study what are the funds available in that particular plan. Suppose every product has got different funds, and then you need to select those funds, which fund is good, and then how you have to you can choose the your investment to go into that fund, where you can, and there is something called switching option. That means you can switch your fund from whenever market is falling, you can switch your fund to the debt fund, where you will not get the risk of the market. Whenever market is going up, you can always switch your fund to equities. For all these, first thing what you need to understand is you need to get knowledge. You need to educate yourself. Which product I'm taking? What is the purpose of that product? Whether this product suits to my requirement or not. These are all very, very important aspects of insurance. Okay. So next thumb rule. Yeah. Emergency fund. So how much you need to save on emergency? Obviously, you need to have at least 6 months. An emergency fund is a financial safety net for future mishaps, unexpected expenses. So you cannot know, like something will come up every time, isn't it? So unexpected things will come up. For that, you need to be prepared. And individuals should keep their emergency funds in accounts that are easily accessible and liquidated. This emergency fund, you should not touch. At any point of time, you should not touch. What you need to do is you need to keep your 6 months, I suggest 1 year, 1 year of income aside as an emergency fund, and you should not invest in anything. You should keep it in your bank account or liquid cash. But that should be properly maintained, and any kind of emergencies, it should at least 6 months, 6 months of your salary, 6 months, it should be put aside. It's a proper discipline. Previously, in old days, we don't follow our older people habits, but if you see, they used to have jars. Mana, if everybody can understand Telugu, they used to, jars unde anamata. Like they used to. So they have separate jars for separate purposes. So they used to keep it in this thing. And whenever something comes up, they used to take out the money. Oh, inta money unda. So that is the practice they used to have. And those practices we left and we spend, in fact, we spend more than what we earn, isn't it? We will start using credit cards left and right, and we'll end up paying a lot of interest. There is no planning, there is no saving, there is no emergency fund, nothing, isn't it? So you need to understand the importance of this planning, and that is why we are telling you very clearly, this is the way that you need to plan. Okay. So, and debt reduction, which is very, very important. See, first of all, when you start taking more debt than your income, your financial balance sheet will imbalance for some time. Like guaranteedly, you will be ending up with more and more debts to service that debts. So first of all, you don't have to take the debt unless until it is very, very important. If somebody wants to go for a housing loan, fine. He has to go for a housing loan, and it should not be overburdened. Okay. So like that, you need to first of all plan properly your debt. And I'm not telling that you should not go for the loan or something. No, you can. But the thing is, how much loan you are taking, whether you are able to service your loan properly or not. Because it's something is coming up, you take it. That attitude is not good. You need to plan properly, like whether I am able to service this loan or not in a proper way. Then only it is possible. So bump up your debt repayment percentage. That means, suppose you are took loan and then you are keep on paying. If you have some extra bonus or extra income from any other source, you start repaying that amount and you will become debt free. See, even in the analysis of stock markets. So I'm there from last 25 years. What we see is debt-free companies. Okay, they don't have debt. So those companies are good companies, healthy companies. Like that, in a person, if you have more debts, you are not healthy in terms of finances. So obviously, you need to reduce your debts significantly by planning properly. Use savings to pay down legged debts. Okay, and negotiate for a lower interest rate. This is what nobody will do. They take the loan just like that. They don't ask how much interest rate, and they don't negotiate with 2-3 banks. Okay, they just go for, okay, he's giving me loan, let me take it. Or some pre-approved offers, they will say that, okay, I'm giving you this loan, and just like that, okay, I'm getting money, let me take it. No, you need to negotiate with the different banks. There are some banks which can give better interest rate, and even 1% of difference can make big difference in your savings. Okay, this you need to understand. And your tax refund check also can pay your debt. Suppose you will get some tax refunds, that also you can, and make more money. See, obviously the point is that when you have debt, you have to make more money. Obviously, you try to make more money and clear the debt, and you can restructure your existing loans. That means you would have taken loan long time back when interest rates are very, very high. Okay, now interest rates are low. So obviously you will be ending up paying that interest, very high interest for the existing loan. So what you can do, you can actually look into your loan and then what is the interest, and you can inquire with the present market. And there are a lot of banks who are ready to take over the loan. So they take over the loan and you will get less interest rates. You can save a lot of money out of it. So this is all you need to do. So if you are ignorant of what is the position you have, so obviously you will end up paying more money rather than making money work for you more efficiently. Okay, so that is what is the importance of the debt reduction. So then when it comes to the goal planning, okay, your goal should be smart enough. What is meant by smart? It should be specific, it should be measurable, it should be attainable, it is relevant and time bound. Okay, it should be some specifically this thing. Say I want to buy a house with 1 crore by so and so time. It should be specific. Okay, if you don't have specification, like I said, you want to go to Dilshuk Nagar, but you don't know whether you want to go to Dilshuk Nagar, you want to go to Kukatpalli, you don't know. So obviously you will end up going somewhere else, isn't it? So you need to have the specific, measurable, attainable, relevant, and time-bound goal. So obviously your goals, whether they have these characteristics or not. So if I ask someone, generally what they say is, I want to buy a big house. So immediately I will ask, what kind of big house, how much it is going to cost, and when you are going to buy, and for that what you have the plan. So everything should be specific, measurable, attainable, relevant, and time bound. So everything should be there. Okay, and segregate short, medium, and long-term goals. There will be short-term goals immediately coming up. Some my children are grown up, and then I have to go for the higher education. That is a very short-term goal. And medium-term, some goals are medium-term, where you want to buy a house maybe after 5 years. So let me plan from now onwards. And there are long-term goals like retirement. I will retire after 25 years, 30 years. Let me plan right now for that. So this is all important. And it can help to achieve multiple goals across different stages of life. So why you need to have short-term, medium-term, and long-term goals is, yeah, you can achieve them properly with the proper planning. That is most important. And your goals must be smart. That's what I said. Example, here is the example of a person who has got saving attitude at the early age. What happens? Here there is a case. So here, Gaurav, he started saving 2,000 rupees every month. So suppose he started an SIP. Okay, and that rate of return, what he is getting out of that investment is only 12%. Okay, I'm not going to take higher range. So it is only 12%, let us assume. And Raghav, one more person, he started 5 years late. Okay, so he woke up at the age of 30, and then he started saving the same thing, 2,000 rupees. What is happening? So after 60 years, okay, what is the corpus that Gaurav is going to have, and what is the corpus that Raghav is going to have? The Gaurav is going to have almost 1.1 crores in his after 30 years in his pocket. But what Raghav is going to have? 61 lakhs only. That means almost around 50 lakhs, 49 lakhs difference is there. Just what is the difference is Gaurav started saving 5 years early than Raghav. So this is the importance of saving, and people don't understand this. So you would have saved from last 10 years this 2,000 rupees per month. You would have got almost like if you calculate in an Excel sheet, you will understand how much you're. That's a compounding effect. That means every year 12% on compounding. If you calculate that much return that you are going to. So saving should become a habit. It's not that you have to save whenever you have extra money. Remove that from your mind and then treat saving as an expenditure. This 2,000 or 5,000 or 10,000 should go as an expense. That means as a rent, as a electricity, as like expenditure which you cannot avoid. So treat it like that, then only you can save, and then only you can build a big corpus for your retirement, for your goals of your life in future. So understand this, very, very important. Right now, what you have, start with that, and then save in a proper way. And we are going to discuss about investment options also in coming slides. So then when it comes to retirement, there are two kinds of things. One is pre-retirement and another one is post-retirement. So in pre-retirement, what that means, you are now, you are still working, but you are not retired. But what are the plans that you have to do? Decide your retirement age first. So I want to work up to 60 years, or I want to work up to 65 years. No, I want to retire at 50 years old. So that is your choice. Okay. Then determine your retirement corpus. How much you need? How much you need after 50 years? How much you need after 60 years? First, decide that corpus. Then calculate future value for your current savings. That means if you are saving now, what is going to happen? How much it is going to build? Suppose you are saving as a for retirement, you are saving 5,000 every month. How much it is going to grow? Whether you are going to achieve your goal, which you declared. After 60 years, I should have this corpus. Whether it can happen or not, you can calculate. That's what exactly we do. Then cut down unnecessary expenditures. So obviously, the only thing, bottom line is that if you don't have a plan, you will end up doing more and more spending and more unnecessary expenditure. But if you have a proper plan, you will end up in saving, which can actually create a bright, wealthy future for you. So this is the bottom line. So post-retirement, see, after retirement, what are the plans that you need? Create, update retirement budget. So you need to have that budget for that. Adjust your portfolio for income. And like after retirement, you are not working anymore. So whether your existing portfolio is giving the right income or not, and safe income. So after retirement, you cannot take risk. So you need to have the safe income and how much per month you want. Basing on that, you need to restructure your portfolio. Learn how to how Medicare works. That means after retirement, obviously you will have health issues. So because of your age, so address that. We need to create that corpus for that also. And refine your mortgage. Mortgage means you may be having some property, you have given it for rent, and you are not revising that rent, or you have some other thing which is not giving you any. That means liability. That means not liability. I can say like what is it? Non-performing asset. Okay, if it is not giving you right return, think about it whether how it can give me more return, so that I can live my life in after retirement. Okay, these are all plans should be considered and do it properly when it comes to retirement. So let us go to the next important subject. What is nothing but investment? Okay, so when we talk about investments, what are the things? Investment is nothing but using money to make more money. So you have money and you have to multiply that money. That is the purpose of the investment. And it involves sacrifice of something now for the prospects of getting something in the future. Obviously, you need to invest. Certainly, then only you can get your future. Investment plan is simplest ways to build wealth over time. Okay, so obviously that is the investment is only one option where you can create your wealth. So first of all, what are the steps behind it? Find and how you are saving. First of all, how much you can save. Suppose, for example, I will lay out a simple plan for you. Suppose you are earning a lakh of rupees. Your necessaries, all expenditure is accumulating to around 50,000-60,000. Everybody go on mute, please. Vamshi, can you address that? Vamshi, please address that. Yeah. So obviously, Vamshi, are you there?
Sir, Vamshi sir is not there.
Okay.
You can unmute also. You have an option.
Okay, fine. No problem. I request all participants to be in the mute mode so that it will not disturb others. Okay, please. And whenever question or answer session is there, you can talk. So find and how you are saving. First of all, what is your saving pattern? Okay, suppose you are earning a lakh of rupees. Out of that, 60,000 is your expenditure. So you have 40,000. So you need to divide into different baskets in a proper way. You need to give it to protection. You need to give it to your investment for all your goals. That means you have child, you need to cater the child education, and then you have retirement plan, and you want to have your goals like car, you have to have house, everything. So this 40,000, how you can allocate a proper way and then fulfill those goals at the time that you declare that I'm going to have this by so and so time. This is most important. Then set your goals. That is next step. First, understand your pattern. For that, we are going to actually, financial planners are going to do the things. Okay, set your goals, declare those goals. Don't hesitate to declare your goals. You can do anything, but declaration is important. So you may have less money today, but you can earn more money. And by declaring the goal, it will actually push you to earn more money. Okay, suppose you declared, I want to buy a house with 5 crores after 5 years. So right now you don't have the situation, isn't it? But that will inspire you to earn more money, isn't it? So declaring goal and then registering that goal is very, very important. Okay, then risk taking analysis. So how much risk that you can take? See, a risk is a relative term. Everything is risk in the world. Even life is at risk. You know that. Okay. So, but how to mitigate that risk? How to take less risk to earn more money? That is all what you can do. So for that, you need to have the knowledge, proper knowledge of risk analysis. Okay. And create saving portfolio. So obviously you need to create a portfolio. Then learn about investment options. What are all options I have to do that? Then asset allocation. That means, okay, now I have got all these options, which option that I should choose? Then build your portfolio. This is how that investment planning can be done. So when you talk about like investment options, what are all options available for us? So yeah, we have this is a very old slide. Some figures might have changed, but in general, they are in the same page. So generally you have equities, that means stock markets. And if you put money into mutual funds, that also goes into the stock market. And obviously, if you put it in insurance, that also is going to stock market. So stock market is become a major like investment source for the people as of now. Because when you see the statistics, there is another thing called gold. So obviously, people invest in gold, then bank deposits, then property, then these are all things. This is the index. WPI index is nothing but inflation and average inflation per the period. See, that is what is very, very important. Understanding is, suppose you are earning 100 rupees this year, you need to earn 110 rupees next year. Otherwise, your money is not going up, it's coming down, because inflation is also going up. That means whatever expenditure that you are putting this year, you are going to put 7% or 8% or 10%. Unofficially, maybe it is more than that. So you have to put more expenditure. That is what is called inflation. So now you bought petrol at 50 rupees. Now you are buying petrol at 100 rupees. You may buy at 120 rupees. So obviously this inflation is going to kill our investments. So you need to understand that whatever investing we are doing, okay, it should beat the inflation first. Okay, it should beat the inflation first, and it should give you more returns. Then only you can able to create your wealth. Otherwise, everything goes into the just for inflation. That means you put your money into the fixed deposit. What is going to happen? They are going to give you some 5-6%. Out of that, again, there is a TDS which they deduct. If you are in the slab of 30%, it is 30%. So you end up getting around 4 to 5%, which is not even sufficient to beat the inflation. But most of the people, they still have the FDs in the banks. They are actually losing money. They are not gaining any money. They need to understand this. Okay, you need to educate yourself which instrument can give me safer investment. If you don't want to take risk, fine. But there are instruments in the market where you will not take much risk, but also you will get more return. Okay, so that is what you need to understand. So this is for an example, gold. Yeah, so the problem is with the gold is like in almost for a period of 10 years, it was there at 25,000 to 35,000. But after that, it has gone up to 56,000. Again, it is trading around 50,000 or 50,000 level. So the point is that sometimes these instruments can be in the same range and it will never give you good returns. Sometimes markets are in consolidation so every instrument, when you are investing, even in property also, suddenly prices will go up, and after that 10 years, it will not be having any raise in the price. So you need to understand what is the pattern of your investment, where you are investing, and how much appreciation you can get, maybe another 5 years, 10 years. You need to have a proper analysis behind your investment, which is very, very important. Okay, so this is what I'm talking about. The killer is the inflation. So obviously inflation is a big killer, and you need to actually beat the inflation. Otherwise you cannot. See, suppose the actual return is 15%, inflation 4% is very less, which is as shown in this slide. It can be more than that. It can be 6%, 7%. Unofficially, it can be 10% also. Post-inflation return, how much it is also out of 15% return, the 4% is or 5% or 6% is going for only inflation. That means you have to spend more money, obviously. So you cannot consider that's a return again. So obviously you will end up getting the after inflation, whatever it is the return, it is the absolute return. So whatever the investment choice one does, everyone should always consider inflation into the picture. This is the most important. So you are making some 20%. No, you are not making 20%. You are making 20 minus inflation. So maybe 6%, 7%. That means you are making only 13%. This is what you need to understand when you are investing into any instrument. Okay. So now let us throw some some focus on investments. So Mr. Benjamin Graham is considered to be the guru of value investing in stock markets. So he says that an investment operation is one which, upon thorough analysis, promises safety of principal and adequate return. Operations not meeting these requirements are speculative. That means an investment is something you should do analysis first. Without that, that is not called as an investment. Okay. Then promises safety of principal. And then we pettina double. Whatever money you invested, it should be safe first. Then adequate return. At least suppose you invested 100 rupees, there is 10 rupees return. At least some return. Okay. If these three things are not considered, it's just speculative. That means without any analysis, without any proper plan, you are investing. So that is speculation. Obviously, there is a chance that you will end up not fulfilling your goals. So any investment needs proper analysis, and it should have safety, and it should have adequate return. These three conditions, if they fulfill, that is only called a right investment. Okay. Then these are the options which we already discussed. So obviously, fixed deposit will kill your money. Maybe real estate, gold can give you exactly that level of inflation and a little 2, 3, 4% consistently. I'm not talking about 1 year. 1 year real estate can give you 200%. I'm not telling. One phase, maybe 10, 15 years, it may grow. After that, it may not grow for another 10 years. We never know. So we need to understand the cycle and which is the best one that we need to do right now. Then next, PPF and national savings, and these are all can give you 7 because government invest in bonds, but there are some locking periods. You cannot take out the money whenever you want. Okay. And the most important, and then entire world is actually looking at an investment option is that is equities or stock market. So why we have to invest in stock market? That is, and how we need to invest in stock market, that need to be understood properly. If you are not doing it without any research and planning, you may end up losing money also, because wherever there is a high return, there is a high risk. So obviously risk is relative term, but what actually eliminates the risk is your knowledge, your analysis. So you see, driving a car is risky. We all know that. Okay. Anytime accident can happen. But without even knowing driving, if you are driving a car, it is more risky, isn't it? There is a 100% chance that they met with an accident because they don't know driving. Something like this. So you know it subject and you know what you are doing. There is a chance of risk, but still you have to take that risk. There is no other option for us. Everywhere there is a risk, isn't it? But not knowing and doing something is the biggest risk of life, isn't it? So knowing something and then taking that risk, yeah, rewards you with the more return, and then you can actually achieve your goals. So let us talk about mutual funds, which is, what is the difference between mutual funds and another option of mutual fund? See, the mutual funds is also investing into stock markets. People who don't have time, people who don't have research, people cannot study the markets, and then still they want to invest in stock market. Because why stock markets will give you the return? I will ask you a simple example. I will tell you a simple example. You are seeing companies like Infosys, TCS, or Hindustan Unilever, top companies of India, you name. Because wherever, see, what is the, first of all, before going to that, I will explain a little bit about stock market. What is stock market's business? Stock market's business is understanding good businesses and becoming a partner with them, isn't it? Suppose your friend is doing good business, he is earning a lot of money. If you go and ask him, like, yeah, I will take partnership with you, will he give? No, because he will not give. Stock market is only one option, getting into the good businesses as a partner. That means when you are buying a share, you are a partner. Even one share, you are one share partner. So, and that company is growing. Along with that company, your money is also growing. So here, what is the point? Is like selecting the right businesses. That means selecting the right companies to create our wealth. That is the most important. And for that, there are two options. One is that if you have the proper knowledge, if you have interest in the subject, you can also start looking at companies and directly invest in stock market by choosing those companies. That is one way where there is a chance that you can make more money. But if you are not having time, if you don't have like interest in the subject, still you want to get benefit out of it, there is another way, that is through mutual funds. Okay, what is this mutual fund? Mutual fund is basically like you can put 500 rupees, you can put 1000 rupees, you can do 2000 rupees. There is no need for you to have a separate this thing. Like if you want to buy some stock, it may be costly and you don't have money. But in mutual funds, it's not the case. This is a fund which is created, and everybody's money will go into that fund, and that fund manager who operates that fund will take the decision of entire money. And basing on his decisions and basing on that performance of that fund, you will get the returns, and it will be distributed accordingly. So this is the concept of mutual funds, first of all. And in that, lot of funds are there, lot of AMCs are there. There are over 40 plus AMCs, that means asset management companies, who are authorized to do the mutual funds, which got permission from the government. Okay, and in that there will be lot of funds. Again, they have different kind of funds that I will explain in that. And what are the advantages of this mutual fund is, one is professional management. The people who are managing the fund is highly qualified. Okay, they know what's happening to the market. And affordable portfolio diversification. Okay, and then you can invest even 500 rupees, or you can invest, and you can divide into portfolio into different funds, different kind of for this. So you can invest in debt funds where there is no risk. You will get certain return, but it may be less. But there are equity funds, there are hybrid funds, there are balanced funds, lot of funds are there. So you can diversify your portfolio. Suppose you want to put some 10,000 rupees, you can put 2,000 in this, you can put 2,000 in that. So like that, you can diversify your risk and then invest. That is the beauty of mutual funds. And economies of scale, basically always economy is growing. Obviously this particular you can see in India now, it's like a revolution in the mutual funds, I can say. So many lakhs of crores of rupees are going into mutual funds in the SIP route every month, people. And it's a good sign, because when we put money into the companies will grow, and GDP will grow, and country will grow. So directly, like, people participating in the businesses is the most important aspect of the economy. And that is what is happening. And liquidity, whenever you want, you can exit and you can take back money. That is the most. And tax benefits for ELSS funds. That means there are some funds which will give you tax benefits also. That, like, you are ending up paying some 50,000 tax. If you put your money into ELSS fund, you can take exemption under 80C. Like that 50, but there is a locking period of 3 years for this. And again, you need to select the fund and see the fund composition, and then invest in that fund to further tax benefit. Then convenient options. That means there are a lot of options available. Investment comfort. You can invest 10,000, you can invest 1,000, you can invest 500. So you can do that. Regulatory comfort. Yeah, obviously, because so many people are involved and so many people are investing in mutual funds, there is a chance that you, unless until market condition, it's only market condition, there is a chance that yes, you will not be cheated at any point of time. It is transparent and it is maintained properly by regulator, because a huge population is involved in this. And systematic approach to the investments. That means there is a systematic, like you can save only 5,000. Okay, you save 5,000 as an SIP. That is systematic investment plan. And I'll explain you what it is. There are two kinds of investment options available in mutual funds. One is SIP and one is lump sum. So what is the difference? Suppose you have 1 lakh of rupees. You want to invest in the market. You can put it directly as a lump sum in any fund. Vamshi, can you manage?
Muted, sir.
Yeah. So mode of investments. Okay. One is SIP, one is lump sum. What is lump sum is, suppose you have 1 lakh rupees. So obviously you will invest that 1 lakh rupees in the market. The problem here is that when market comes down in a correction, obviously market will come down and go up. Both the things will happen. When market comes down, obviously your value is going up. You should not be fearful by looking at your portfolio or it is in minus. No, it is temporarily will be in minus, but market is always going up. If you see from last 30, 40 years data, it will always have corrections, but always it is going up because companies are growing. No company is falling. It is always growing. Last year to this year, this year to next year, companies are growing only. So obviously you're investing in the companies. Obviously growth will be there. Only thing is temporarily there may be a correction and temporarily there may be this thing. But if you take up SIP route, that is systematic investment plan, every month you are going to invest. It's not going to be the lump sum. And for financial planning, we suggest SIP to everyone. That was, suppose people are who is saving only 5,000 rupees per month after all this expenditure. But again, I'm telling you, you have to change your mindset that 5,000 is also an expenditure. First, remove that, and then whatever left you spend. So this has to become as a traditionally, you need to change your mindset. Like, yes, I need to first save, then after that only whatever left I'm going to spend. Otherwise, I'm not going to spend. So once you do that, how much you can save, there is always a figure where you can start investing into different kind of SIPs. That means if you are investing in 10,000, you can put this 2,000, 2,000, 2,000 in different funds, 5 different funds, and then it will diversify your risk as well as it will give you good return. This is how SIP works. So why SIP? Why SIP means basically expertized, personal, disciplined investment approach, safe and transparent, lower cost, and main advantage is compounding. Suppose you invested this month 2,000 rupees here. Market came down. Again, next month you are going to invest 2,000. Market further came down. Again, you are going to invest 2,000. So obviously, when market goes up, you are going to have the compounding return. That means you have your investment every place in the market. Okay. In lump sum, it will not happen. Lump sum, you invested there, market came down, your value is good. But here in SIP, every month you are going to, so your risk is also average and your return is also higher because it is the compounding. That's why I always suggest to invest in mutual funds only through SIP route rather than lump sum. Yeah, if you have used money and you don't want to invest in direct stocks, you can also do that, but you need to wait. You cannot say that, okay, I've just put money and then now from now it will be going. So you need to understand the trend of the market, and you need to understand whether market condition is bullish, bearish, consolidation, or whatever it is, and then take the call accordingly. So for everything, the knowledge is important, and that knowledge is responsibility. That is your hard-earned money, and you are working very hard for it, isn't it? Almost you are spending entire life on earning money. So obviously, when you are investing, it should not be ignorant. You should know where it is going, why it is going, whether it is required for me, and how it is actually giving me the return. Everything you should know. Then only you can invest. Okay. So in mutual funds, there are a lot of things like large cap, mid cap, small cap, multi cap, sectorial funds, thematic funds. There are a lot of funds are there. I think it's an ocean. Like there are about 3,000 plus funds are available in the market. So equity. So there are large cap means large companies, mid cap is mid-sized companies, small caps is small caps, multi cap means mix of all these things. Sectorial funds is basically like theme wise, like IT, like pharma, like this thing. When you do the sector analysis, if you feel that some sector is going to perform, you can put the funds in that that sector, and every fund they will give you the stock composition. If markets, like if you have good knowledge in stock markets, you can also see which are all companies are available in that fund. You can also actually do analysis of those companies, and then if you feel that these all companies in that fund can perform, you can invest in that. This kind of research that you need to do before investing in any fund. Then debt fund is basically like it's a government bonds and like company commercial papers where they will give you interest. You are just going to invest, they are going to pay you interest, and you need to see that whether that particular commercial paper is sound. That means it's a AAA rated fund or not, and you need to cross check few things before investing into that fund, and what is the consistent return interest that they are paying. So in that, there are ultra short term. That means even for one day you can invest in that fund. That means there are companies who are having crores in the bank balance. Okay, they don't want to keep it in bank. They can invest for one day also. That is one ultra short term. Ultra short term means in days. Then short term, maybe from week to 3 months, and then long term is again years, 1 to 5 years. Then income funds. Income funds is something like liquid funds. So basically, like, these are all different funds are there where you have to choose the right funds. And hybrid funds is something like equity plus debt. That means 50. Suppose I don't want to take much risk, so I will put my 50% in debt, where it will give me some 7-8% return, and I will put 50% in equity. Like that also you can plan, where you will get guaranteed return as well as you will take little risk and then get more return in the equities. So that is what is called hybrid funds. Okay. So generally, what kind of returns that you can expect is liquid funds around 6.5%, debt fund around 8 to 10%. Long-term debt, it is around 11.5%. Balanced fund, maybe you can expect around 12 to 13%. This is all average. It's not confirmed. Okay. There is nothing called this will give you this much. It's an average. Okay. Large cap, balanced equity, large cap funds, multi-cap funds, mid and small cap will always give you more return. But when market falls, they are going to fall first. So that is also important. So if you want a long-term perspective, so my suggestion, if you want to invest in mutual funds, plan for 10 years, minimum period of 10 years, or at least 5 years. So you start investing in an SIP every month, 2000, and treat it as an expenditure and forget about it. It will grow, no doubt about it, because markets always will go up. Maybe it's a matter of time. Maybe 1 year they may be down, but next year they are going to perform. And it is the one of the best asset classes available for the investments. If you see the statistics of all over the world, which is the best asset class to invest is only equities, because all other asset classes may perform for some time. But again, average, if you take, equities is the best investment option as of now in the world. Okay. So let me throw some light. I think a lot of our stock market participants are also there. They know this subject, but anyway, for the benefit of other people, I wanted to throw little light about stock market. Let's look at direct investing in stock market. Stock markets is the business of understanding best businesses available, becoming partner in those businesses. That's what I said. Understand the best businesses. Tata Motors is the best business. SDFC Bank, best business. I'm not telling best business. You have to analyze whether it is best or not. Like some company yeah, it's going to grow, no doubt about it. So invest in those companies where along with that company, your money is also going to grow. That is the concept of stock market. And what that we need to know to invest in stock market. One is fundamental analysis. That is understanding the business model of the company, understanding the company, how they are performing. So how they are doing. That is what you need to understand. That is what we say fundamental analysis. Okay. And then technical analysis, understanding the price behavior. That means where people are buying, where people are, and that means where people are appreciating this company. Suppose, for example, take example of onion or commodity or tomato. At certain prices, certain level, people are ready to buy. Okay, and that is what we need to identify even in the companies. Okay, if it comes to that level, it is not coming down further. That means what is happening? People are buying. So you need to understand where people are buying, and then you need to buy at that places. So understanding that price behavior, the subject is called technical analysis. When you want to invest straight and directly in stock markets, you need to do a little bit of research. I'm not telling you that you should become an expert, but you should do some kind of research, or you have to have somebody like us who can partner with you in giving that research. Okay, so that is what it is. So fundamental analysis are different approaches, which I explained already. Fundamental analysis is the reason for that company to grow. Technical analysis is the where people are buying and where people are selling. Simple. So that company is good or bad, and whether it can perform or not will be decided by the fundamental analysis. Technical analysis, okay, now it is good, where to buy? Ekkada konali. That is what is technical analysis. Ee rendu nechukodam pedda, it's not a rocket science. Only thing is you need to have some interest and you need to cater some time to do your own research. Okay. And for that, yeah, this is what it is: economy, industry, and company. This is what we said, top-down approach. You first of all understand the economy, and then understand the industry, and then understand the company in that industry. That means in this economy, which industries are going to perform, and in this industry, which company is the best company to invest. So that is what is called top-down approach. Bottom-up approach is you will first understand the company because you know that company. You are looking at that company for a long time, and then you will study whether this company has got right prospects in that industry or not, and then whether it can perform in this economy or not. So you are going to go to the bottom to top approach also sometimes, but generally we prefer top to bottom, where you can drill down and shortlist your companies. Okay. Technical analysis is basically understand what is happening to the price in the past, to predict what might happen in the future based on such understanding, and define entry and exits. This is what is important. So good news is, like, people who want to invest directly into the stock markets, we conduct a program. I think a few of people in this session also, they did our program. We give a basic understanding about how actually you can invest in these markets. So to avoid risk, without even no driving, getting into the car can certainly make you accidents. But what we do is we try to teach the driving. That means how you can actually look into the markets, how you need to understand these markets, and what companies are good, and how you. So there is something called mentorship program, which we will run, where we will conduct 6 sessions to give the knowledge. And after 6 sessions, there is a personal coaching available for the people who are all interested. They will take coaching for the 6 months. Okay. So obviously this is one of the best programs in the industry, which is proved that so many people they are actually started investing in stock markets and doing good. That is what is what we are also into. Okay. The people who are interested, like, to invest directly in stock markets, don't do it without knowledge. Get some knowledge, learn it, and then do it. That is what it might. Otherwise, you choose mutual funds and invest in the mutual funds. Okay. So then asset allocation. When it comes to asset allocation, you should decide what is your style. Are you a conservative trader? Are you a conservative person? Or moderately conservative, moderately aggressive, or aggressive? Suppose that you can be aggressive in the age of 30. Okay. Because you are like, okay, fine, I have a lot of future, I can take risk, I can take little more risk, and I can make more money. And moderately aggressive, then maybe your age is between 30 to 40, and moderate maybe 40 to 45. Moderately conservative maybe 50 to 60, and very conservative after 60. So obviously your age and your approach, maybe I cannot say that there are people who are at the 60, they are very aggressive. I'm not telling that you should be like that. So in general, you should have this kind of approach, and basing on that, we can suggest what is the portfolio that you can go ahead with your approach. So that is what it is. So obviously, this is also important. Rebalancing the portfolio, obviously, like you need to see the market condition and restructure your portfolios. Suppose market is coming down, you shift your funds from equity market to debt market, where you will get some return, which is good. There is no risk. So when markets are performing, you shift your funds to the risk. You can do it in mutual funds. You can do it in ULIP policies also. In fact, we do it for our clients. We never keep the funds idle. What we do is, whenever we feel that market is going to come down, we are going to shift those funds to debt funds. And whenever market is going to go up, we are going to shift that funds to equity funds. So like that, even ULIP plans, you have a switching option where you can switch your funds. If you feel that another maybe 1 year market is not going to be good, you can switch your funds and you can safeguard your principal capital always. So it is all about dynamically managing with the knowledge. That is more important when it comes to financial planning. You should involve because your money is involved. Okay. That is what is called rebalancing. So next chapter is tax. So there are three common things. There is tax evasion, that is completely illegal. Tax avoidance, you know that you can avoid tax. In some cases you will avoid, but we don't know. Like nowadays compliance is too strict by this government. Obviously, it is better that you plan properly. You can do tax planning. So arrangement of one's financial business affairs by taking full benefits of all deductions, exemptions, allowances, extra, so that reduce to the minimum. Whatever you are paying should be the minimum. So in that, there are a lot of sections out there. Out of that, the main section is 80C, where you can get PPF, ELSS funds. If you go for the insurance, if it is term insurance or ULIP or life insurance, and term insurance is nothing but life insurance, or FD, these are all will come under 80C up to 1.5 lakhs. Apart from that, if you want to save more, you can actually invest in 80CD, CCD. That is one more section where you can invest in National Pension Scheme of the government or Atal Pension Yojana, where you will get extra 50,000 benefit. That means you can save up to 2 lakhs if you want to save. Then next thing is NPS, anyway, it is there. And next thing is if you have a health insurance policy for your family, you will get up to 50,000 of this thing. And if your parents are also covered in that, above age of 60, you will get up to 75,000. So there are like lot of sections available. And there is a 80DD, medical treatment for dependent with a disability. Okay, alage medical treatment dependent with disability, severe disability. Like that, there are different sections, and you can also donate to the charitable organizations, and sometimes it covers 50% and sometimes it is 100%. And then housing loan is one of the things, that is section 24B, where you will get exemption up to 2 lakhs. That means if you are going for a new house loan, your interest paid on the housing loan up to 2 lakhs is exempted extra. So obviously these are all things that you need to understand when you are paying your tax. Suppose, for example, you are earning ₹1 lakh and that 12 lakhs is your annual income, and how much tax you are paying. So once you calculate how much tax you are paying, you can actually claim these benefits and avoid the tax, so that you can save that money in different forms, which can be used after some time for your purposes. So instead of paying to the government, that effective tax planning can be done. We have our auditors on board, where they will give our clients suggestions regarding the tax planning, and we do effective tax planning for our clients basically. Okay, that is the part of the financial planning also. So next thing is financial planning process is how we do it exactly. So how we are going to do it is simple. We see, you are going to a doctor. What are all you are going to say? You are going to say that here I am getting pain and this is what is happening. You will tell everything. Like that, financial planner is also a doctor for your wealth. Okay, for your finances, because they are going to give you the right suggestions which can improve your financial health. So obviously you need to give your data properly, then only we can give proper planning. So there is gathering client information. First of all, information will collect. There is something called data gathering sheet, where we will ask you all your goals that I will explain. Establish goals, objectives, analyzing financial situation as of now, where you are with your income, with your thing, where you are. We will analyze that first. Then developing and presenting financial plan. So we will develop the plan for you. Okay, now you are able to save 20,000. How you can save 20,000 effectively to get your goals? Okay, and you may not have. Suppose somebody came and told me in another financial planning session, I want to earn 1 crore rupees within 5 years. How much is earning right now is 35,000. So how can it? So only thing is, that's what I mean to say. So goal should be realistic. Okay, and then you need to increase your appetite. You should try to reach your goal by earning more money. But whatever it is there, how you can plan better and how you can actually go for the right investment, right plan. That is what a financial planner can help you. He cannot give you money, isn't it? So obviously what he can give you, he can give you the right advice. So that's what exactly we do. And implementing the plan and review the plan. So basically it's not about implementing. Suppose, for example, you invested in a mutual fund. Market, we thought that market is going to come down. Then we are going to review your fund and say that, yes, market is going to come down. So what we will do is we will restructure your fund. That means you will take out this fund, put it in debt fund, and again. So this is what we have to do continuously, and that will keep on doing. Our financial planners will keep on doing. Okay, so this is how financial planning works. So I will just explain why you have to come to us. I should give a reason for it, isn't it? We have rich experience of 2 decades in financial markets. First, the thing is we have strong hold in the subject of financial markets and empowerment with the right financial education. First of all, we are interested to educate people. Okay, we don't want to tell you, sir, please come to me, I will give you everything. No, we will educate you where you are, how you are, and what you are doing, and then what are the things available, and what are the bottlenecks out of it. That means which is good, which is bad, how it is happening, and you will understand what it is. So comprehensive financial plan. We don't want to give half solution. We wanted to give you as per your goals. That means you have these goals. For that, you need to have this much money, and for that, you need to strive to earn that kind of money. Giving right tailor-made plan by understanding life goals. That's what exactly I said. And research support in mutual funds and stock markets. We have research team in mutual funds as well as stock markets, where we analyze funds, we analyze stocks, and that support is being provided by us. Then structured products like PMS. Suppose somebody don't want to invest in mutual funds or direct stock markets, there are some structured products where PMS, that means you invest in products, but as per SEBI now, the PMS investment should be minimum of 50 lakhs. Okay, but there is something called PMS advisory from us directly, where we can suggest you how to manage your portfolio. You may have to share some profit with PMS, and as well as there will be some charges for it. Who we manage your portfolio. That is what is called PMS. Okay, portfolio management service. And portfolio restructuring existing. That means you have mutual funds. You have so many mutual funds you already invested. You have insurance already you took that plans, and you have stocks already you took that stocks. If you send your portfolio, we will study and then we will restructure them and we will give the right suggestions to you. Okay, which one is good, which one is bad, you can take it out and you can put this. So this is what is called restructuring of the portfolios. That also we will do, and dedicated desk for the support. So obviously our desk will support you always in mutual fund division as well as stock markets division. So this is what it is. And what next is basically like we will send you a data gathering sheet to fill. First of all, you have to fill your data, evaluate your existing portfolio. First of all, we have to evaluate your existing portfolio, suggest you on the best one depending upon your goals and income statements. So whatever you give data, basing on that, we'll suggest some suggestions. And comprehensive financial plan, periodic review of the plan. This is the way that financial plan works. You give the data, we analyze that data, will come out you give the existing portfolio, and what are the ingredients of it. This is how the data sheet will be. So you are going to give your professional information like name, date of birth, annual income, source of income, maybe source of income if you give or not, that's not a problem. Then mobile number and all common. Retirement age, this is important, and life expectancy, that means how many years. Yeah, that is what I want to, I will live up to 100 years. Okay, that is my expectancy. Then family details, you have married, not married, if you are married, spouse name, and income and expenditure. This is very, very important. How much income per month, per annum, and how much expenditure per month and per annum. Then existing mutual funds. Okay, what are all funds you have? Then existing insurances, what all you have? Existing loans, what all you have? Maybe deposits and retirement account like PF, cash, and future goals. This is the most important point where you need to fill. Like future goals, retirement, child education, child marriage, house, car, vacation, wealth creation, business, and others. So all your goals should be 100% clearly, specifically mentioned, and basing on your present income and present this thing, how many goals at what time you can achieve. We are going to lay down a perfect financial plan and we are going to work with you. Okay, so that is what it is. So this is the data gathering sheet where we will send it to each and every participant of this program after this program. So people who are all interested, they can fill the data and send us. We will give the mail ID and all, and then we will work on that and we'll get back to you with the suggestions. and this is all free as of now for the participants. But after that, in future, yes, obviously you want to have review every 3 months of your portfolio, or you want our personalized services in stocks, mutual funds, that will be chargeable. But as of now, this free basic financial planning, what we are going to do is free for you. Okay, this is all about this thing. And now I will open the session for the question and answers. Okay, I hope that this is a very big subject. I hope that I could able to create some sense of financial planning, why it is important, what are the things involved in that, how you can do it. I think I justified my job, and I think you have to tell me like whether you all understood, and any more doubts or anything that you want to ask, you can please ask me the questions. Now I'm going to yeah, just a minute. I will. Yeah, this is my number. You can note it down. 733-110-7814, and the mail ID is prasad@wealthtree-group.in. So you can note down this number, yeah. So this can be, you can send a mail, or you can send you can call us, you can call me directly, not a problem. So, and then our people also will get in touch with you, and because your mail IDs are there, we will send the sheet to your mail ID, and we will work one-to-one after that. Okay, this is how it is. So now I'm stopping the share and open this thing for the question hour session. Okay, yeah. Yes. Overall, having questions, you can unmute yourself.
Once again, good afternoon, sir.
Yeah.
I am Monica. I have a small doubt. I have one query, sir.
Definitely.
Is it a good time to invest in mutual funds, sir?
Yeah, anytime is good time.
Okay, sir.
Why I'm telling you is always companies are growing, isn't it?
Yes, sir.
So obviously economies are growing. Even in economies also, there will be some recession sometimes. Suppose in 2008 there is a recession. Again it has gone up. And in COVID time market has come down, but again it has gone up, isn't it?
Yes, sir.
So obviously always investing in mutual funds is good in a systematic investment plan. That means every month 1,000 rupees, 2,000 rupees, you should make a habit of saving.
Okay.
Yeah.
Thank you, sir.
Thank you. Thank you. Yes. Any more doubts, questions, or anything you want to share? Yeah. Yes, sir. Tell me.
Hi, Prasad Garu. This is Kishore.
Nandakishore garu, cheppandi.
Yeah, so thank you. That was very, very crisp and very, very detailed. I think I really like the presentation. I think you have covered cleared most of my doubts. But one question. So I saw that the investment returns, what you have mentioned in the real estate, it's something which is very around 4%, which I think I mean, according to my knowledge, I think the real estate returns are quite high. But your recommendation is more into the equity. So can you explain why is the real estate
basically that is the average return. That was the older slide. But the point is that real estate, that is also moves in a cycle. So there are lot of things, in areas that is again need to do something. But these statistics which are provided is the worldwide statistics. Maybe right now Telangana, that to Hyderabad may have the bull cycle which is running. Okay, maybe after 10 years, there may not be, after 5 years or after few years, there may not be any growth. Like that, we have seen that cycle even before also. But when you take world's average, asset class wise, equities is the number one.
Okay.
Got my point. Right now, you might be seeing some prospect in real estate. Yeah. In fact, if you see the real estate index of India, last 20 years that index is fallen, and recently it has started moving up. So
Okay.
next big sector in India is going to be, one of the thing is going to be infrastructure as well as real estate.
Hmm.
So in
Right.
that way, what will happen, getting some 15-20% returns is not a problem. But when you take an average since maybe 50 years or 60 years, if you see, gold also gives you returns, this kind of returns sometimes, no doubt about it. But the point is that, yes, if you take that average, that equities is the best outperforming asset class in the world. That is the statistics given by the
Okay. Got it. Yeah. Thank you.
డౌట్స్ లేని వాళ్ళు, if there is no doubt for you, please be on mute. మిగతా వాళ్ళకి డిస్టర్బెన్స్ అవ్వకుండా ఉంటుంది.
Okay. So, any more questions? I think somebody is not.
Vinod Kumar is texted in chat, sir.
Okay. Fine. So if you have like what I suggest you is, instead of any doubts regarding the subject, you can anyway. What I will do is I will share this PPT also along with the mail which we send it to you with the data gathering sheet. So what you can do, you can refer the PPT also. You can get back to us with any kind of doubts you have. You can call us and we can help you. The most important thing, 2 points I want you to get very clear is that saving should become a habit. Number 1. Number 2 is that if you want to save, where you need to save. That is what it is. So Nandakishore garu, one more thing what I share with you is like suppose you want to invest some 10,000 rupees every month. Can you invest in real estate? No. But you can invest in the stock markets like mutual funds. So this
Correct.
is option. So that is what it is. You need to have huge money to get into the investment also. So these are the things that you need to consider. What is the general option available and what is the best option that we have right now? If you say that you are saving some 10,000 rupees every month and accumulating that and buying a property is a big thing, isn't it? So now what you can do, you can keep on investing in mutual funds where they will give you a average return of compounding return of 12 to 15%, which can take you to your goal after 10 years, no doubt about it.
Sir, are you a certified financial analyst?
We have certified financial planners with us.
SEBI certified? Are you SEBI certified?
Certified financial planning is a separate course. It's not SEBI. We have SEBI certified research analysts.
No, sir. What is my question is like, you are suggesting stocks, mutual funds, personal finance.
Yeah, that's what it is. We are mutual fund distributors, AMFI certified, and we are SEBI certified research analysts, and we have certified financial planners in our company, CFPs. Got the point?
One question, sir. Like, so middle-aged person now, inflation is high, real estate is high, equity is high, and all gold is high. So in this situation, like I have a option like investing in real estate and investment, like equities and those things. Okay. So what do you suggest? Like either in middle-aged person can go to his real estate side or equity side. So what is your analysis and suggestion?
Basically, like real estate is something like you cannot invest in every month, isn't it? That's what I explained. You need to have huge money, first of all, number 1. Number 2, as an investment option, if you want to buy a house, you buy. That's a different thing. That is not at all connected with the financial plan. That's a goal. But if you want to make money out of real estate investments, you need to look into at least 5 to 10 years, that also. And then you need huge investment. I'm not telling that real estate will not give you money. It may give you money. Every asset class will give you money. But the point is, what is the consistently giving money? We are talking about that.
Yeah.
Obviously, we never say that. Always there is a saying that you should not put all eggs in the same basket. That means you have to diversify your portfolio in different investment options. You should put something in gold if you have more money. But if you have only 2,000 rupees or 10,000 rupees you can save per month, you tell me what is the option?
So, that's fine, sir. If I having my salary is 50,000, suppose, okay. So
Uh,
I'm paying EMI 25 to 30,000. So where can I invest in equities or mutual funds?
That's why mutual funds is the thing what we are suggesting. That too in a SIP mode,
Yeah, which one
which
should I
will be
follow?
safer, and compounded return you will get long term. And you should look for at least 5 years.
Okay, so you mean like it's better to go for SIP.
SIP, yeah, systematic investment plan.
But SIP is not beating inflation, sir. That's a problem. See, if I see like I'm investing last 2006 and I invested in mutual funds, but it was not able to beat the inflation when I sold at 2014 or 15.
Average return, I have the statistics. I don't know where you invested, which funds and all. Average return, any period of 10 years, it is more than 12% in mutual funds.
They are telling 12%, but you should be a personal analyst, then only it's possible. Because
Maybe.
you have to know the
That's what I
knowledge of
said. That's what I said. Before investing, you should know.
debenture to equity, then only it's possible you can get 12%.
That's what I mean to say. You need to, first of all, educate yourself to invest in the right things.
Yeah, if you invest and you forget, then you'll get a negative returns. My experiences.
Everybody knows what's happening to the market. It's not that you and me, we have to decide on that. But the point is that in 2021, market rallied more than 100%. All mutual funds have given 70-80% returns. Point is that only thing is consistently keeping the investment in this thing, and restructuring your portfolio is also needed. You might be taken something which has not performed. I'm not denying that. But overall, it's not about me telling something. It's the market why crores and lakhs of rupees are going to SIP is that there is no other option. What are the options available? If you invest in FD, you will get negative return, and there is no other option. So 12% may not be, even 10%, it's a good return. So obviously, SIP always given any period of 10 years. It has given return of 12 to 15%, and the statistics are available. But if you choose any different fund which has not performed, we don't know about it. So you can send your portfolio. Let me study and get back. Okay.
So your final decision would be like investing in real estate is better or equities?
Again, I'm telling you, if you have crores of rupees, you can invest as a business, as an investment. How much you can invest? Can anyone invest 10,000 rupees every month into real estate?
No, if I have some savings, if I want to invest,
You can. I already told you, you can put all eggs in you can put in different baskets. If you have more money, obviously I suggest you to invest in all. You buy some gold, you buy some real estate, you buy some stocks, you distribute your portfolio into different baskets. Okay. So people who have got any more questions, because I have to be with the other program by 1 o'clock.
Yes, sir.
Please get back to us. I have given my number. You can call me anytime. And I want you to properly plan. And if you want us to study your portfolio, send us your portfolio. We will come out with our research report on that, and we suggest you the right things. Okay. Fine. And all people will send you the mail, and we will send this PPT also, so that you can cross check and then you can do that. Thank you very much for all of you to attend this. And then certainly the 2 points what I want to make it is, one is that make savings as a habit. Second one is that improve your knowledge before you're investing into something or taking any insurance or selecting any funds, anything. Okay. Thank you. Thank you, one and all. Yeah, Mr. Nagendra Patel. Tell me anything.
Hello, sir. Hello.
Yeah.
Sir, I've been investing in SIP mutual fund from past 7 years almost. Whatever you told just now, as I was trying to learn 6-7 years back from some internet resource, and I can agree to that. I'm getting really a very good return. After 6-7 years, I can see almost all my funds have doubled. Whatever I invested, even though few of them might have ups and downs, but almost on average it has doubled. But same time I started also investing in share market. But if I see my shares have really not performed, hardly I have got 10 means 5% not return, even 4-5%. But wherever my mutual funds are almost doubled, so I agree to that. But just I'm trying to understand now. I'm investing more into technology fund like ICCI Technology. So I just want to know, can I invest little bit more into pharma fund, because I understand the cycle now little bit. So pharma fund, just I want to know.
I got your question. What I mean to say is like every sector will have some correction. Like now IT sector corrected. Okay, it's a good level. It is at good level to invest. But the only thing is you need to think about long term, not short term again. So whatever sectors corrected, if you want to invest in thematic funds, that means sectorial funds, you need to study that sector, whether this is the right time to invest. That's why research comes into the main play. So as we are into research from last 25 years, so we can suggest you the funds and the sectors also, but it is for longer term, not shorter term. And when you are venturing into the direct investing in stock markets, you have to improve your knowledge, how to pick the good companies and where to make an entry and exit. This is where we run our mentorship program. If you are really serious to invest on your own in directly stock markets, you need to learn. You can, otherwise you choose mutual funds. Anyway, it will give you good returns. Got it?
Yes, sir.
Thank you. So yeah, in a matter of time, I think it's 12:30, but already half an hour we have spent, and I really appreciate all of you to participate in this and having a great time. And we are there for you to help you to understand, make you understand what is important to build your proper financial plan. And certainly you can always approach us for your financial plan. Anyway, our people will send you all the data gathering sheet. People who are interested to have proper financial plan, our certified financial planners will do it. You can send your data, and you can also send your portfolio existing, where we can do research on that, and we can suggest some changes also. Okay. Thank you one and all for attending the session.